Hello, you people of the interwebs. Ian Eichelberger here. Already did my walk, so kind of recording this because I wanted it to be a little bit more structured. But what I want to talk about today is what what's a safe number for you to have as a monthly payment when you're buying a house. Now, me as a mortgage broker, I have very strict rules that I follow, and you'd be surprised the amount of money I can qualify somebody for on a house. And just because I qualify for that doesn't mean you should do that, because I can qualify for almost half of your pre-tax income to go towards a housing payment and you get qualified. But I'll tell you, that makes life pretty stressful when half your pre-tax income is going to your house and then you got your other bills. The math doesn't math, if that makes sense. So what I would recommend is you take about 30% of your income, just so whatever your pre-tax income is, multiply it by 0.3, and then that's a good safe number to start with. And then what I would then do is then add all your other bills. And I'm not just talking about the things that pop up on your credit report. I'm talking about your subscriptions, any non-reporting credit stuff, any bills you're sending to friends, family, whatever, food, budget. Add all that stuff in there and make sure you have a comfortable, range when you're making that house payment. Now, if after adding all that stuff in there, it doesn't, it looks pretty tight, and once you add all that, you have like zero disposable income at the end, then I would highly recommend you start paying down those other debts. Because for every like $50 you can reduce in other debts or subscriptions or whatever, can get you about, I don't know, like $5,000 to $10,000 more in a purchase price. So if you want to buy more house, cut those debts down. Now, this is sort of like a Dave Ramsey-esque strategy, but then what I would do is that's on a 30-year fixed, 30% of your pre-tax income to qualify. I know he talks about doing the 15-year, but that's tough for a lot of people, especially in this circumstances. So buy that house, 30% of your pre-tax income, your payment's comfortable. Then when rates drop, just shorten your term. So if you can keep your payment the same and knock 5 years off of a term, or 10 years, or even 15 years off a term, and keep your payment about the same that you're comfortable with, then you're going to save tens, if not hundreds of thousands of dollars over the life of that loan. So it's a great way to kind of hack the system, save a ton of money down the road, and really get in the house that you want to get into. So hope this helps. If you have any questions, reach out, like, subscribe, and I'll see you on the next video.